Do you know the secret sauce for growth stocks? Unveiling the SPGP ETF. Hey everyone, welcome to Chat ETF. Today we're diving deep into a fund many growth investors are curious about, the SPGP ETF. We all know growth stocks can be amazing, but sometimes they can feel a little expensive. That's where the SPGP ETF comes in. It uses a fancy strategy to find companies with growth potential, but at a price that won't break the bank. But is the SPGP ETF the perfect fit for you? We'll explore the benefits, drawbacks, and even how it compares to picking your own growth stocks. By the end of this video, you'll know if the SPGP ETF deserves a spot in your portfolio. Stick around, because on Chat ETF, we crack the code on ETFs. And maybe help you find your next big winner. Question 1. What is SPGP ETF? The SPGP ETF, or Invesco SP500 GARP ETF, offers an investment strategy targeting growth stocks with attractive valuations. Let's break down what this means. 1. Focus on growth. SPGP tracks the SP500 Growth at Reasonable Price Index. This index selects companies within the SP500 that exhibit high growth potential. Growth is typically measured by factors like earnings per share and sales per share growth over a specific period. 2. Balancing with reasonable price. While focusing on growth, SPGP doesn't simply chase the hottest stocks. It incorporates quality and value characteristics into its selection process. Quality refers to factors like profitability, management strength, and balance sheet health. Value compares a stock's price to its underlying fundamentals, ensuring you're not overpaying for growth. In essence, SPGP aims to identify companies with promising growth prospects, but at a price that reflects their true value. This approach can be appealing to investors who want exposure to growth stocks, but with a reduced risk compared to pure high-growth strategies. Question 2. What is the SPGP ETF's primary investment objective? The SPGP ETF, or Invesco SP500 GARP ETF, has a primary investment objective of achieving long-term capital appreciation by investing in growth stocks at reasonable prices. Here's a breakdown of this objective. Long-term capital appreciation, SPGP isn't designed to generate high current income, like a dividend ETF. Instead, it focuses on the potential for the holding's share prices to increase over time. This capital appreciation translates to a profit for investors when they sell their ETF shares at a higher price than they bought them for. Growth stocks at reasonable prices, GARP. The key aspect of SPGP's strategy is its focus on companies with high growth potential, but at valuations that are considered reasonable. This means the ETF seeks stocks that are positioned for above-average earnings and sales growth, but avoids stocks that are excessively expensive relative to their fundamentals. By combining these elements, SPGP aims to deliver a portfolio that benefits from the growth potential of its holdings while mitigating some of the risks associated with pure growth investing. Question 3. Does the SPGP ETF track a specific index? Yes, the SPGP ETF specifically tracks an index called the SP500 Growth at a Reasonable Price Index, GARP index. This index is crucial to understanding the investment strategy of SPGP. Here's a breakdown of how the index shapes SPGP. Benchmark. The SP500 GARP index serves as the benchmark that SPGP tries to mirror in its performance, before fees and expenses. By tracking this index, SPGP offers investors exposure to the same basket of stocks the index holds. Selection process. The SP500 GARP index starts with the entire SP500 universe. It then applies a screening process to identify companies with high growth potential. This is typically measured by factors like earnings and sales growth over a specific period. Quality characteristics. The index considers factors like profitability, management strength, and financial health to ensure the companies are fundamentally sound. Value considerations. The index incorporates valuation metrics to avoid companies that are excessively expensive relative to their earnings potential. Index weighting. Once the companies are selected, the SP500 GARP index weights them based on their growth scores. Companies with stronger growth prospects have a larger influence on the overall performance of the index, and consequently, the SPGP ETF. Benefits of tracking an index. Transparency. The index methodology is publicly available, allowing investors to understand the selection criteria and weighting of holdings within SPGP. Passive management. Since SPGP tracks an index, it is passively managed. This means the holdings are automatically adjusted to reflect changes in the underlying index, reducing costs associated with active fund management. Diversification. By holding a basket of stocks selected by the SP 500 GARP index, SPGP offers some level of diversification within the growth at a reasonable price strategy. Question 4. Does the SPGP ETF employ any quantitative investment strategies? Yes, the SPGP ETF relies heavily on quantitative investment strategies to achieve its objective of long-term capital appreciation through growth stocks at reasonable prices. Here's how quantitative strategies play a role in SPGP. Index selection weighting. The underlying index, SP 500 GARP, utilizes quantitative factors to select and weight its holdings. Factors like past and projected earnings growth, profitability metrics, and valuation ratios are all objectively measured and analyzed using quantitative models. These models help identify companies exhibiting strong growth potential while also considering quality and value aspects. Passive management. SPGP tracks the SP 500 GARP index passively. This means there's no active selection of stocks by fund managers. Instead, the ETF relies on the quantitative framework of the index to determine its holdings and their weightings within the portfolio. Benefits of quantitative strategies in SPGP. Objectivity. Quantitative analysis removes emotion and human bias from the investment process. Decisions are based on predefined factors and models, leading to a more consistent and objective approach. Efficiency. Quantitative strategies allow for efficient analysis of a large universe of stocks like the SP 500. This ensures a wider range of companies are considered and potential opportunities are not missed. Transparency. The factors and models used in the SP 500 GARP index are generally well-defined, allowing investors to understand the overall investment strategy of SPGP. Important considerations. Model dependence. The success of SPGP ultimately depends on the effectiveness of the quantitative models used in the SP 500 GARP index. These models may not always capture all the relevant factors impacting a company's performance. Market fluctuations. Even with quality and value considerations, growth stocks can be more volatile than value stocks. Quantitative models might not perfectly predict market movements, leading to potential fluctuations in the ETF's price. Question 5. How frequently does the SPGP ETF rebalance its portfolio? Here's a breakdown of the rebalancing process for SPGP. Tracking the index. The SPGP ETF strives to mirror the holdings and weightings of the SP 500 growth at a reasonable price index, GARP index. Periodic rebalancing. The SP Dow Jones Indices, which maintains the GARP index, conducts rebalancing semi-annually. This ensures the index holdings and weightings remain aligned with its selection and weighting methodology. ETF adjustment. Following the rebalancing of the GARP index, the SPGP ETF makes adjustments to its own portfolio to reflect the changes in the index. This might involve buying or selling certain holdings to align with the updated weightings within the index. Reasons for semi-annual rebalancing. Maintaining investment strategy. Rebalancing helps the ETF stay on track with its objective of investing in growth stocks at reasonable prices. As stock prices fluctuate, the weightings of individual companies within the index can deviate from the target allocations. Rebalancing corrects these deviations and ensures the portfolio reflects the desired growth and value characteristics. Reduced tracking error. Tracking error represents the difference between the performance of the ETF and the underlying index. Regular rebalancing helps minimize this error by keeping the ETF's holdings closely aligned with the index. Important considerations. Transaction costs. Rebalancing can involve buying and selling securities, which incur transaction costs. These costs are ultimately reflected in the ETF's expense ratio. Short-term impact. Rebalancing activity can cause short-term fluctuations in the ETF's price as holdings are adjusted. However, this is typically a temporary effect, and the long-term goal is to maintain alignment with the target investment strategy. Question 6. How has the SPGP ETF performed in different market conditions? The SPGP ETF, or Invesco SP 500 GARP ETF, targets growth at a reasonable price, and its performance can vary depending on market conditions. Here's a breakdown of how SPGP might perform in different scenarios. Bull markets, rising markets. Potential for outperformance. During bull markets, growth stocks tend to outperform value stocks. SPGP's focus on growth stocks with some value considerations could position it to benefit from rising markets. The emphasis on reasonable price might help mitigate some risk compared to pure growth strategies. Example: if the overall stock market significantly increases, driven by strong economic growth and positive investor sentiment, SPGP could potentially experience greater gains than the broader market due to its concentration on growth stocks. Bear markets, falling markets. Increased volatility. Growth stocks are generally more volatile than value stocks. SPGP's exposure to growth stocks can lead to larger price declines during bear markets compared to ETFs, with a more defensive allocation. Example: in a scenario with a recession or significant economic downturn, SPGP might experience steeper losses than the broader market as investor confidence weakens, and growth expectations for companies diminish. Neutral markets, flat markets. Performance uncertain. In neutral markets with little overall movement, SPGP's performance becomes more dependent on stock selection within the GARP index. The balance between growth and value characteristics in the ETF could lead to returns more aligned with the broader market. Example: during periods of stagnation or slow economic growth, SPGP's performance might be more closely tied to the selection of companies within the index. The ETF's focus on reasonable price might offer some stability compared to pure growth strategies. Overall, SPGP historically offers the potential for higher returns than the broader market during bull markets, but also carries the risk of larger losses during bear markets due to its focus on growth stocks. The ETF's performance in neutral markets is more dependent on the specific holdings within the SP 500 GARP index and the effectiveness of its selection methodology. Question 7. What are the key risks associated with the SPGP ETF's investment strategy? The SPGP ETF's investment strategy of targeting growth at a reasonable price comes with inherent risks that investors should be aware of before considering this ETF. Here's a breakdown of the key risks. 1. Growth stock volatility. Larger price swings. SPGP focuses on growth stocks, which are known for their amplified price movements compared to value stocks. This translates to potentially higher returns during bull markets, but also steeper losses during bear markets. Investors with a lower risk tolerance might find the volatility associated with SPGP challenging. 2. Macroeconomic sensitivity. Economic downturns. Growth stocks tend to be more sensitive to economic cycles. During recessions or periods of economic weakness, companies' growth prospects can diminish, leading to significant price declines for SPGP's holdings. 3. Quantitative model dependence. Investment strategy reliant on models. The SP 500 GARP index, which SPGP tracks, utilizes quantitative models to select and weight its holdings. These models may not always capture all the relevant factors impacting a company's performance, potentially leading to suboptimal investment choices. 4. Limited diversification. Concentration on growth stocks. Compared to a broad market ETF, SPGP holds a smaller number of companies focused on a specific growth and value strategy. This lack of diversification can amplify the impact of negative events on individual holdings and potentially lead to higher portfolio volatility. 5. Expense ratio. Ongoing fees. Like any ETF, SPGP has an expense ratio that covers management fees and other operational costs. These fees eat into the overall returns of the ETF. While the expense ratio of SPGP might be lower than actively managed funds, it's still a cost to consider. Question 8. Does SPGP ETF contribute to portfolio diversification? The SPGP ETF can contribute to portfolio diversification to some extent, but it's important to understand its limitations. Here's a breakdown of how SPGP can influence diversification. Limited diversification within its niche. Focus on growth at a reasonable price. SPGP targets a specific niche within the stock market, growth stocks with reasonable valuations. While it holds a basket of stocks, around 75, it lacks the broad diversification of an ETF that tracks the entire SP 500 or a total stock market index. Benefits for overall portfolio. Growth potential. Compared to a purely value-oriented investment, SPGP can introduce growth potential to your portfolio. This can help achieve your long-term growth objectives alongside your other holdings. Reduced concentration risk. By including SPGP, you're not relying solely on a single company or a small sector. This helps mitigate the risk of a single company's performance significantly impacting your entire portfolio. Limitations to diversification. Exposure to growth stocks. SPGP remains concentrated on growth stocks, even with its focus on reasonable valuation. This means it shares some of the inherent risks associated with growth stocks, such as higher volatility and sensitivity to economic cycles. Limited asset class coverage. SPGP focuses solely on equities within a specific growth and value strategy. A well-diversified portfolio typically includes a mix of asset classes like bonds, real estate, and commodities to further spread risk. Maximizing diversification with SPGP. Combine with other asset classes. To achieve a more comprehensive diversification strategy, consider pairing SPGP with ETFs or investments from other asset classes. This could include bond ETFs, real estate investment trusts, REITs, or commodity ETFs. Balance growth and value. SPGP offers growth potential, but it can be complemented by value-oriented investments within your portfolio. This can help create a balance between growth and stability. Overall, SPGP can be a valuable addition to a portfolio seeking growth potential, but it shouldn't be the sole source of diversification. Consider its niche within growth stocks and combine it with other asset classes and investment styles for a more well-rounded and diversified portfolio. Question 9. Are there other ETFs with similar objectives of SPGP ETF but lower expense ratios? Yes, there are several ETFs that share similar objectives with the SPGP ETF, Invesco SP500 GARP ETF, but potentially offer lower expense ratios. Here's a breakdown to help you compare. SPGP ETF. Objective: targets growth at a reasonable price by tracking the SP500 GARP index. Expense ratio: you can find the current expense ratio for SPGP on the Invesco website or financial websites, Invesco SPGP. It's important to consider this cost as it affects your overall returns. ETFs with similar objectives and potentially lower expense ratios. iShares SP500 Growth ETF, IVV, tracks the SP500 Growth Index, focusing on large-cap growth stocks, but without the value consideration of SPGP. It might have a slightly lower expense ratio compared to SPGP due to its simpler index methodology. Vanguard Growth ETF, VUG, tracks the CRSP US Large Cap Growth Index, offering exposure to large-cap growth stocks in the U.S. market. Vanguard is known for its generally lower expense ratios, so VUG could be a potential option for cost-conscious investors seeking growth exposure. Schwab US Large Cap Growth ETF, SCHG, tracks the Dow Jones US Large Cap Growth Index, providing another alternative for investors interested in large-cap growth stocks. Charles Schwab, similar to Vanguard, often offers competitive expense ratios, potentially making SCHG a cost-effective option. Question 10. Could a combination of individual stocks or other ETFs achieve a similar outcome with potentially lower costs or greater control? Yes, it's possible to achieve a similar outcome to the SPGP ETF, Invesco SP500 GARP ETF, with potentially lower costs or greater control by combining individual stocks or other ETFs. Here's a breakdown of the pros and cons of each approach. SPGP ETF. Convenience: offers a ready-made portfolio of growth stocks with some value considerations. Diversification: provides exposure to a basket of companies within the growth at a reasonable price strategy. Lower costs than actively managed funds: expense ratios are typically lower than actively managed funds. Individual stocks. Greater control: you can choose the specific companies you want to invest in, aligning your portfolio with your investment thesis and risk tolerance. Potentially lower costs: you avoid the expense ratio associated with the ETF. However, commission fees for buying and selling individual stocks can add up. Higher research requirements: requires in-depth research and analysis of individual companies to make informed investment decisions. Increased risk: individual stocks can be more volatile than a diversified ETF, potentially leading to higher portfolio risk. Combination of other ETFs. Tailored diversification: you can combine ETFs with different focuses, growth, value, different asset classes, to create a portfolio that aligns with your specific goals and risk tolerance. Potentially lower expense ratio: by strategically combining ETFs with lower expense ratios, you can potentially reduce overall costs compared to the SPGP ETF. Management complexity requires research and selection of multiple ETFs, potentially increasing complexity compared to a single ETF. Question 11. What are the pros and cons of this SPGP ETF compared to similar options? Here's a breakdown of the pros and cons of the SPGP ETF, Invesco SP500 GARP ETF, compared to similar ETFs that target growth at a reasonable price. Pros of SPGP ETF. Tracks a defined index. SPGP offers transparency by following the SP500 GARP index. This means investors understand the selection criteria and weighting methodology used for the holdings. Passive management. The ETF's passive management style translates to lower expense ratios compared to actively managed funds. This can benefit investors seeking a cost-effective way to access a growth at a reasonable price strategy. Diversification within growth strategy. SPGP holds a basket of companies, around 75, within the growth and value niche, offering some level of diversification compared to a single stock. Quantitative investment approach. The ETF relies on quantitative models to select and weight holdings, potentially reducing emotional bias from the investment process. Cons of SPGP ETF. Limited diversification. While it holds multiple companies, SPGP remains concentrated on growth stocks with some value considerations. This limits diversification compared to a broader market ETF. Higher expense ratio than some competitors. There might be similar ETFs with slightly lower expense ratios, especially those with simpler index methodologies. Exposure to growth stock volatility. SPGP's focus on growth stocks inherently leads to higher volatility compared to value-oriented ETFs. Reliance on quantitative models. The effectiveness of the ETF depends on the accuracy of the quantitative models used in the underlying SP500 GARP index. Question 12. What are the potential benefits and drawbacks of investing in SPGP ETF compared to individual stocks within the same sector? Here's a breakdown of the potential benefits and drawbacks of investing in the SPGP ETF, Invesco SP500 GARP ETF, compared to individual stocks within the same sector, growth at a reasonable price. SPGP ETF. Benefits. Diversification, owns a basket of companies, around 75, within the growth and value niche, reducing risk compared to a single stock. Convenience, ready-made portfolio, avoiding the research and selection burden of individual stocks. Passive management, lower expense ratios compared to actively managed funds. Transparency, tracks a defined index, with clear selection and weighting methodologies. Quantitative approach, reduces emotional bias in investment decisions. Drawbacks. Limited diversification, still concentrated on a specific sector, growth at a reasonable price, compared to the broader market. Lower potential returns. Diversification can also mean lower potential returns compared to a well-chosen individual stock. Less control, no influence over specific holdings within the ETF. Exposure to average performance, performance tied to the average performance of the underlying index holdings. Individual stocks. Benefits. Higher potential returns, the potential for higher returns if you select winning stocks within the sector. Greater control, you choose the specific companies you invest in, aligning your portfolio with your investment thesis. Potentially lower costs, avoids the expense ratio of the ETF, but commission fees for buying/selling individual stocks can add up. Drawbacks. Higher risk, individual stocks can be more volatile than a diversified ETF, leading to potentially larger losses. Extensive research required, requires in-depth research and analysis of individual companies to make informed decisions. Time commitment, selecting and monitoring individual stocks can be time-consuming. Emotional bias, investment decisions might be influenced by emotions rather than objective analysis. Choosing between SPGP ETF and individual stocks. The best option depends on your investment goals, risk tolerance, and resources. For beginners or risk-averse investors, SPGP ETF offers a good balance of convenience, diversification, and lower costs. For experienced investors with time for research, selecting individual stocks allows for potentially higher returns and greater control over your portfolio, but requires significant research and risk management. A hybrid approach, consider combining SPGP ETF with a few well-researched individual stocks to balance diversification with some control over holdings. Question 13. Does SPGP ETF offer a unique exposure that wouldn't be easily replicated through other holdings? The SPGP ETF, Invesco SP500 GARP ETF, doesn't offer completely unique exposure that cannot be replicated through other holdings, but it does provide a specific combination of characteristics that can be valuable for some investors. Here's a breakdown. Limited uniqueness. Focus on growth at a reasonable price. While the growth at a reasonable price (GARP) approach attempts to identify companies with growth potential at attractive valuations, this concept isn't exclusive to the SPGP ETF. Overlap with other growth ETFs. There are several ETFs in the market that target large-cap growth stocks, and some might even incorporate elements of value considerations within their selection process. Potential value proposition of SPGP ETF. Specific index methodology. The SPGP ETF tracks the SP500 GARP index, which has a defined methodology for selecting and weighting holdings based on growth potential, profitability, and valuation metrics. This specific combination might appeal to investors seeking a rules-based approach to growth at a reasonable price. Passive management and transparency. The ETF offers a passively managed portfolio with lower expense ratios compared to actively managed funds. The transparency of the underlying index methodology allows investors to understand the investment strategy. Convenience and diversification. SPGP ETF provides a convenient way to gain exposure to a basket of growth stocks with some value considerations, offering some level of diversification within this specific niche. Replicating or achieving similar exposure. Combining growth ETFs and value ETFs. Investors can potentially replicate a similar exposure by strategically combining a growth ETF, like iShares SP500 Growth ETF, IVV, with a value ETF, like Vanguard Value ETF, VOE. This allows for more control over the specific growth and value allocations within the portfolio. Individual stock picking. For experienced investors, selecting individual growth stocks with a focus on reasonable valuation metrics can achieve a similar outcome. However, this requires significant research, analysis, and carries a higher risk of underperformance compared to a diversified ETF. Alright everyone, there you have it. The SPGP ETF offers a unique twist on growth investing by targeting companies with good growth prospects, but at a reasonable valuation. We explored the pros and cons, the convenience of diversification, the transparency of the index methodology, but also the limitations in terms of overall diversification and the reliance on quantitative models. Remember, the SPGP ETF isn't a magic bullet. It might be a good fit for some investors, but not everyone. Here's how to decide. Are you new to investing or risk-averse? The SPGP ETF offers a good balance with its built-in diversification. Do you have time to research individual stocks? You might consider a more tailored approach by combining growth and value ETFs, or even picking your own stocks. No matter what path you choose, do your research and understand the risks involved. Thanks for joining us on Chat ETF today. If you enjoyed this video, don't forget to like and subscribe for more in-depth ETF breakdowns. We'll see you on the next one.